So here we are, Hartley, for the serious, hardy souls who really want to hear about allocations to private markets in such a difficult environment. We were talking backstage a bit about how everybody has been talking today about the fact that retail is going to be where the action is in terms of allocations to private markets. You have the advantage of having been working with retail customers and putting them in private markets for a while. Can you just give us a sense of where is that, how does that process differ, and what have you learned so far?
Absolutely, Brooke, thanks a lot, and hi everybody. Hamilton Lane has worked with high net worth individuals for a very long time. In fact, when I came into Hamilton Lane, one of the investors in the company was the Bill Gates family office, and that gave us kind of an entree into the family office world, which in the last few years has expanded sort of down market from a size standpoint. And so we started principally outside of the US because it was easier from a regulatory standpoint to get products marketed. So we set up a Luxembourg product that today has $2.5 billion or so in it. And we launched about 2 years ago a US product that's also moving along very nicely as well and is in these channels. We're a multi-manager, which means we're putting people into a product where the underlying transactions are being managed and sourced by a variety of different private equity managers, generally middle market type managers, as opposed to the very big single product managers.
Now, the title of our session is The Impact of Monetary Tightening and Market Volatility. So I think that's the backdrop for this move of putting individual investors into private credit, private equity infrastructure. Can you give us a sense of sort of, given that we are in a difficult environment, I mean, look at the Dow today, where you see both the opportunities and the pitfalls?
Sure. I mean, obviously, I'm a huge believer in private markets. Our data at Hamilton Lane, which is one of the largest data sets in the industry, suggests that private markets has outperformed public markets, both in the equity markets and the private credit markets, for every single one of the last 20 years. And so you've seen up markets, down markets, global financial crisis, recovery from the internet bubble, and all of that, private markets outperforming. So we're big believers in private markets generally. And so from our standpoint, we think that not being public in the underlying companies is a great thing because they don't have to watch the stock price every day. They don't have to worry about what the market thinks about different things that they're doing. In addition, the governance of private markets businesses is a very strong thing in our view. You have boards of directors that are generally very involved with the companies, that are real experts, that are put there by the private equity sponsors. You have management teams that are heavily incentivized by stock, so the alignment between management teams and the shareholders is very strong. And because so many fewer companies are going public today and are public, private equity is one of the only ways to access a big swath of the US and the other developed economies around the world. So if you're looking for growth companies, smaller companies, private markets are really the way to find them.
There's a lot of talk about the fact that valuations in the public markets, both credit and equity, have come down, but obviously it's only starting to trickle through to the private markets because, of course, there's no mark to market. How does that impact this retail push and bringing new customers in? Obviously, if you already own it, it doesn't really matter to you whether it's getting revalued right now. But what about the new people?
Well, it's not really true that they don't trickle through. Private market valuations are pretty sophisticated today. And if you look, for example, in the buyout world, which is the biggest part of the private markets, there's a lot of marking to market that goes on based on declining multiples. What's happened in buyouts has been that the earnings have been very, very strong of the underlying companies. So you've had significant increases in performance in buyout portfolios that have offset the decline in multiples. So if you look at the numbers in buyouts in the first quarter and the second quarter of this year, in mid-market buyout in the US, they are flat to slightly up because of the performance of the underlying companies. And that's marking them with the multiples of public comps, which is what people do. So it's much more sophisticated than it used to be. I think if we talk about the venture and growth markets, It's slightly different. In the growth markets, you've got a situation where many companies raised money last year in 2021. They raised a lot more than they needed, and so they're sitting on multiple years of burn, and you have growth funds that are sitting there looking at these companies and saying, I'm not going to invest at the price you raised money at last year, but the entrepreneurs and the venture capitalists are saying, well, we don't want to take a markdown. So you've got a little bit of a standoff in the growth markets today. Not true in the seed venture markets. Those are still very active, and I know in this conference there's been a lot of conversation about the digital assets stuff, and so that's still pretty vibrant at the seed level. It's in the growth level where you've seen the biggest slowdown, because you've got a sort of a bid-ask spread that's sitting there that could take 18 to 24 months before you begin to have real price discovery in the growth markets.
Do you think, which one do you think is right? I mean, did they need to come towards each other, or are, current management teams who want to keep their high valuations going to have to take a check of reality?
In a market where great public companies that were trading at 30 times next year's revenues are trading at 15 times next year's revenues, take Snowflake, for example, or other very high quality tech companies, it's hard to justify paying more than that for a private company, even one that's very, very good. So I think the answer to your question, Brooke, is what happens to the stock market. If you tell me where the NASDAQ is a year from now or 18 months from now, I'll tell you where the venture valuations are going to be.
And if you could tell me that, we'd all be richer. What's the impact on that on the private credit market? Because I know I have heard, and I'd be interested in your experience, that for companies that are not quite as flush with cash, that don't want to raise at a lower equity value, that they may be turning to credit. Is that starting to come through? Absolutely, and that's a very interesting area actually in growth capital and venture capital, because companies are doing that. There's a kind of a movement in Silicon Valley and in the other places like Silicon Valley for venture debt to become more of a thing, and it's a way for companies to bridge their needs without actually having to raise fresh equity. So that's very specific to the venture markets. Generally, private credit is a very strong and healthy business right now. As the banks pulled back from lending to leveraged buyouts and lending to smaller companies in the after the global financial crisis, private credit companies stepped in. And those markets have developed enormously, and they cover a huge range of structures and types and all kinds of things. And the returns have been very good, and they remain very good. The opportunities remain very good there. Now, the bankers would say, yeah, but they haven't lent through a credit cycle yet. Do you think that the new crop of private lenders and the funds that you allocate to are they ready for what's clearly happening to us right now? Well, I think there's a question of whether or not we go into a recession. And I think, obviously, the inflation numbers today would not indicate that we're going into a recession, although you can talk about, stagflation or whatever. But I think right now we don't see in our companies recessionary tendencies. And so I don't see the need for a massive restructuring capabilities right now. It just doesn't feel that way. Companies are healthy and growing, and in our private credit portfolios, companies are performing well. The number of defaults is very, very low. So having said that, the private credit people are people who've been in it for a long time. These are not, the ones we invest in are not new people to the industry. And so they've seen cycles, they have restructuring capabilities if they need it. But as I said, we don't see any sign of that right now. The companies are performing very, very well. Sounds like it's a great time to get into private assets. So let's talk about these retail folks who will be coming into this market. How are they going to deal with what is clearly some volatility? The whole attraction of private markets would be that you didn't have to think about volatility, but maybe you do. What do you do about that? Well, I think it's a question of really what would you rather own. I think what you've seen over many, many years are the best performing institutions and large family offices having very large allocations into private markets, both venture capital, buyouts, private credit, more recently private infrastructure, private real estate.
all of those things really driving very significant returns. And so when people talk about the legendary performers, the Yale Endowment, or the Massachusetts State Pension Fund, which is one of the top performing pension funds in the country, or a big sovereign wealth fund, or a big family office, those people have allocations to illiquid assets that are often in the 40 to 50% range when you take it all in. And that is much higher than where private individuals are. So the kind of modern thinking about it is almost to barbell your portfolio, where you have some very liquid stuff here that you're going to use to fund what you need for the next several years. So you know for the next 3-4 years, you've got the capital that you need to live, to fund your university or fund whatever it is. And then you can take the other part and tie it up in longer term investments that should earn a higher rate of return, and which have earned a higher rate of return for 20+ years, as I said before. So I think individuals look at that and say, why can't I have access to the same thing? Previously, it was hard. It was hard for regulatory reasons. It was hard because of the structure of the industry in terms of the way funds are raised and funds are priced and so on. But today, the private markets are enormous. And there's a lot more regulatory understanding of what's in the private markets. The valuations, as I said before, are much more credible and much more constantly marked. I mean, we value all of our direct equity and credit investments get valued by S&P every month. And so there's a lot more transparency that people can feel comfortable with on that. And so they have the ability to access these kinds of investments in ways that they haven't before. And the American retail and global retail sales channels are much more familiar today with these as well. So courtesy of things like the Blackstone products that have been so successful in retail in the last couple of years, as well as the multi-manager products that people like us have been putting into the pipes. They've worked well, and people are comfortable with them. We have not seen, even during the course of this year, wholesale flight from our products at all. We've continued on a quarterly basis to net raise money into the products, and it still feels good.
Do you think there's any risk that with everybody trying to sell to retail, that there's going to be too much out there and there'll be some bad products?
We are a long way from that. I think the gatekeepers are pretty good. You know, the people in the RIAs and the wirehouses and so on, they know these markets and they know who's good and who's not good. And so I really don't see that as a risk. I think there's a long way to go for retail investors to get from where they are today to where they could be in terms of having, or where they'd like to be in terms of having an appropriately structured portfolio.
If you were looking into your crystal ball, and obviously none of us can know whether there's going to be a recession or not, if you were a new investor coming to market, and you were allocating to privates, where would you go? Would you, 1/3 private equity, 1/3 private credit, 1/3 infrastructure? What's your dream allocation?
Well, I think you're doing it because you want to drive some alpha, but in the high net worth channels or the retail type channels, and I use the words kind of interchangeably because the U.S. has a layering of wealth levels that you can get to. And so for what they refer to as accredited investors to participate in these channels, that's a newer thing that's coming along.
Yeah.
Whereas the slightly higher levels, the qualified purchasers and qualified customers, there's a lot more available to those people today. And so I'm going to speak as if I'm speaking to that audience.
Because they have the choices.
Because they have the choices a little more than taking it down to accrediteds today. But I think what you want to think about is for your evergreen products, the products that have some element of liquidity to them where you can get your money out, those tend to be balanced in terms of generating the liquidity. So they'll have a healthy allocation of private credit, which will be shorter duration and have some yield attached to it. They'll have a big allocation of private equity secondaries, which are also shorter duration that will throw off cash. So those portfolios kind of produce an amount of liquidity every year that people can then take, if they want, out of the pool and then put into other areas. We are big fans of small and mid-market buyout. That, over the cycles, has tended to be a very solid performer for the reasons I said before, that they're accessing parts of the capital, parts of the economic structure that are not easily accessed in the public markets, and yet these are people that are adding value. You're not speculating a ton on new technology and things like that. So we're kind of mid-market buyout is the area that I think is sort of blends risk and return in the healthiest way.
That sounds like a good pitch for people. as we're looking at, do you have a feel for, where the private markets go in the short term? Sort of nobody, as I said, nobody knows in the long term. But for now, what's up? We've got 1 minute left. What's your prediction for the next 6 months?
I mean, I think that's a macro question at the end of the day, because the private markets are so big that they really respond to macroeconomic. It's hard to answer that in a micro sense. And so on the heels of a big inflation number today, I'll say something controversial, which is I don't see inflation continuing. I think the Fed would say that 2/3 of inflation's been generated by supply chain issues, and we see supply chain issues starting to ease. And so I think you're seeing a little bit of after effect of what had happened before. You and I were talking about stimulus before that as well as being a cause of that, and that's not a bottomless pit either. And so our own view is that in the very short term, yes, high inflation, another interest rate rise, probably, maybe 2 more. But if you look out 6 months or 12 months, our feeling is, and you can already see it in the price of oil, our feeling is that you're going to have more pressures released that are going to bring inflation down and the pressure on interest rate rises down. That will be good for private markets.
That makes sense to me. We are out of time, but how nice to end on a positive note.
Great.
Thank you so
Thanks,
much.
Brooke. Thanks,
Appreciate
everybody.
it.